The market is no longer reacting to reality. It's reacting to headlines about reality. And that sounds small, but it changes absolutely everything. Because once markets stop pricing in what's real, they start pricing in what might happen next. And you no longer have price discovery. At that point, you have complete narrative control, liquidity, expectations, policy decisions, not fundamentals, not war, not truth. And by the end of this video, you'll see exactly where that pressure leaks. Because right now, there is a huge disconnect in these markets. War escalating, markets rallying. Ceasefire rumors, markets rallying again. Deals failing, treaties failing, markets barely moving. Now, that's not a market reacting to interpretations of possible events, of possible futures. It's price detaching from reality. And that attaches an expectation loop, which if you get stuck in it for too long, your portfolio will be the ultimate victim of this war. So what's the real hidden mechanism? Here's how the system actually works. Bad news triggers a growth risk, which then inspires central bank responses. Markets go up. That's the simple plumbing. So why is the market reacting the way it is and not tanking? Well, what's happening? It's asking a question. What will the policymakers do because this is happening? That's the entire game. Don't worry about the prices of the S&P or the NASDAQ. The entire game is about the policy response. The reality is completely secondary. Think back to 2008. In 2008, the system credibly broke. It legitimately broke. The S&P fell 57%. Yes, banks collapsed. Unemployment absolutely surged, but markets didn't bottom when things went wrong. They bottomed when the central banks came in to save the day, when QE number 1 was announced. Not when the reality improved on the ground, only when the liquidity started to be promised. That was the real shift. That's always the only shift that matters. It goes from pricing the outcomes to pricing the intervention. When the big boys, when the daddies are going to come in and save the day.
All this wealth, and still you grovel for scraps. Pathetic.
Please, Master. We only ask for a chance to recover our losses.
Because when you realize this, you realize that QE never left. It just metastasized. It just evolved. It changed into repo injections, emergency lending, balance sheet expansions. Different names, same function ultimately. To inject that liquidity into the market when it's needed. To inject that hopium when the stress appears. To inject that manna from heaven when markets start to erupt. Bad news equals liquidity becomes expected, which triggers interventions. It's a self-fulfilling prophecy. Markets don't need the instability, they just need the narrative. Imagine a siren. At first, it signals danger. Then one day, out of nowhere, money falls from the sky. Eventually, people stop reacting to the danger and they start waiting for the money. It's almost Pavlovian, if you know that experiment. They wait for the money, they anticipate it, they even begin to hope for the siren because they know what it triggers. Because the signal no longer represents the reality. It represents the savior, the stimulus, the liquidity. That's the loop. That's the loop we have to understand. So why isn't this a conspiracy, and why is this how the market actually works? The system does it automatically. Governments need stability. Central banks need functioning markets in order to disseminate their policy. Funds need returns, and investors need to feel a privilege of safety. Everyone moves in the exact same way. They stabilize, they inject, they suppress the volatility, not by design, it's by necessity. It's what needs to be done. In Capitalism 101, this is how the system works. But the outcome is always the same. Reality gets muted, risk gets transmuted. And if you don't believe me, let's talk about the data. Let's look at the pattern. 2020, unlimited quantitative easing, market stabilized. 2023, banking crisis, again, promises of unlimited QE and repo intervention. Why? Because the markets are pricing in speed of response, speed of policy intervention. They don't care about the severity of the event per se. They're just worrying about what's going to be done about it. You're trading the reality when in fact you should be trading what the eventual outcome is going to be from the liquidity injections. Bad news equals market rallying, you buy, and then you get trapped and you wonder, why is this not working? This makes no sense. Well, it's because you're on the wrong layer of thinking. This is why it feels like the market is designed to take your position, to sucker you in, because structurally, it is. That's why it all works the way it is. And this is exemplified no better than in what we've seen in gold recently. This is why gold and silver aren't exploding. Because if war leads to liquidity, support, intervention, then metals don't spike immediately. The system always absorbs the shocks first. And that goes into the dollars and into treasuries. But the absorption is not the resolution. It's the delay. It's the delayed pressure. And the pressure does what pressure does. It builds. But where does the pressure go eventually? Look at all the previous crises, even the previous wars, where we've seen this kind of same thing play out over and over again. First, the metals and all these markets crash, and then with the eventual promised liquidity that's always promised and intervention is always around the corner, we get a huge rip-roaring rally when people realize that the debt's still the same, the currency debasement is exactly the same, the asset inflation is the only way that we know how to get ourselves out of this quagmire, and underneath the surface is always the same, unstable, compression, like a spring just waiting to explode, and no longer can that persist without the writing being on the wall. And when it is apparent, the violence in the markets is what you see, a rip-roaring rally. In the 1970s, it was exactly the same. Policymakers tried to manage the perception. They controlled the inflation expectations through rhetoric and through intervention. They tried to stabilize the system, and obviously it worked. Until it didn't work. And then gold didn't rise slowly, it repriced absolutely violently. The same with silver, because once confidence completely breaks, adjustments aren't gradual anymore. They are completely sudden. And that's the reality of it. You're not trading these markets. You're too busy trading reality and thinking, why aren't things plummeting, when in fact these markets trade on intervention. It's not about resilience, it's about a system. It's about a system protecting itself, about pricing its own intervention instead of the reality itself. And that works when you understand it, until the reality obviously forces its way back in. Because reality never disappears, it just accumulates. It builds, it metastasizes, it coalesces, and it traps you in a trade that you think makes sense, but obviously doesn't, because you're not trading the liquidity. So the next time these markets move, don't ask what happened, ask something else entirely.
Oil prices could surge dramatically.
What does the market
Inflation
think
would spike.
policies
Central banks
are
would face an
going to
impossible
do
dilemma.
next? Because that's the true mechanism. That's the true distortion. And that's why everything feels completely off-centered, off-balance, because you're not crazy. It just is the way it is. And once you see it, you can't unsee it. And then you start to see exactly where this pressure leaks. The long story short is that these crises never actually end without liquidity being injected. And when liquidity gets injected, that is the writing on the wall. That is when you invest full throttle. That is when you go full port. No, I'm joking, you don't go full port, but that's when you start to allocate capital. You can see the tentative signs of this right now in these markets, tentatively bottoming out as we see the resolution is coming to an end. But we still realize that we're still in debt, we're still printing huge amounts of money, the dollar debasement is still going on, central banks around the world are still irresponsible, people's cost of living is still rising, and the value of your savings and your children's future still seem sensitive and on the brink of corrosion and erosion. So the real game here is never ever pricing in the reality. It's always about thinking about what's going to happen down the road, how the policymakers are going to intervene, because that's going to decide where the capital is truly flowing to. And I know it sounds bizarre, it sounds counterintuitive that you shouldn't be pricing reality, but think about whenever you've allocated to an asset based on immediate headline news. It's normally the incorrect head fake, the initial move. The initial move is not always where the eventual move ends up, and that's purely because expectations and reality are completely different things. So when you're thinking about how to allocate that capital, think through it clearly. Markets don't price reality, they price expectations. My name's Justin Banton, this is the House of Trade. Good luck out there.